So right now we have two classifications of accounts. We have the capital expenditure and the revenue expenditure. So when we make mistakes in the course of recording our transaction, for example, let us say if capital expenditure is first, you have to note that whenever you make mistakes in calculating or in recording capital expenditure for revenue expenditure, it's going to affect both the income statement and statement of financial position. Please note that. Now, whenever we mistakenly record a capital expenditure for revenue expenditure or record a revenue expenditure for capital expenditure, it's going to affect our statement of financial position and at the same time affect our income statement. Now, how does this mistake or this error affect our statement of financial position? How does this error affect our income statement? So we start with capital expenditure. They said if capital expenditure is treated as revenue expenditure, profit will be overstated as the expenses will wrongly increase, while the statement of financial position will be understated as non-current assets will be understated. What they are saying is whenever we mistakenly record our capital expenditure for revenue expenditure, it means we have increased our expenses, and as a result of that, we take away the expenses from the profit we make. So what happens to our profit? Our profit will decrease. Do you understand the point here? You have recorded capital expenditure for revenue expenditure. You are supposed to record it in the statement of financial position, but you record it what? You recorded it in your income statement. As a result of that, you have increased the expenses of the business. And when you increase the expenses of the business wrongly, when you wrongly increase the expenses of the business, the profit of the business will fall. That is why your profit will be understated. Do we understand?
Yes.
Capital expenditure is supposed to be recorded in your statement of financial position, but you wrongly recorded it in your income statement. What happens to your income statement? Your income statement would have more of expenses, and more of expenses will reduce the profit of the business.
Yes.
That is the point. Do you get it now?
Yes.
More expenses will reduce your profit. So two things has happened.
What is this called?
No, errors. The impact. It's a negative impact now.
Yeah.
You recorded, listen,
Understood.
it's a capital expenditure. You are supposed to record it in your income, in your statement of financial position, but you recorded it in your income statement. Two things have happened. One, your capital expense, your assets would be reduced instead of increasing. Yes or no?
Yes.
So that is statement of position, financial position will be understated as current assets will be what? Understated. You have mistakenly taken an asset, wrongly posted an asset in the income statement. So your profit and loss account will have increased in terms of expenses. Your statement of financial position would have reduced because you did not record the non-current assets you purchased. So your profit will be understated, your non-current assets, your statement of financial position will be understated because you purchased an asset, which is supposed to increase the value of the asset, which is supposed to increase the value of your statement of financial position. But you did not record it in your statement of financial position. You recorded it in your income statement. So your asset will have reduced, will be understated. At the same time, your profit will be understated. Is it clear?
Yes.
That is for capital expenditure. Now for revenue expenditure. If revenue expenditure is classified as capital expenditure, then profit will be understated as expenses will be lower, while the statement of financial position will be overstated. Now, you recorded a revenue expenditure into a capital expenditure account. What happens to your statement of financial position? You increase the assets wrongly. So it means that your assets, your statement of financial position will be overstated. And what happens to your income statement? It will be understated.
Yes.
Is it clear? Any question about it? Capital expenditure, when it is wrongly posted as revenue expenditure, it reduces, it understates your statement of financial position, it understates your profits and loss account. Revenue expenditure, when it is wrongly posted as capital expenditure, it overstates your statement of financial position,